Hi everyone. In this video, I'm going to discuss accrued expenses, which are one of the 4 types of adjusting journal entries. My goal is to make the concept as simple as possible, yet to maximize your understanding. So, what are accrued expenses? These are expenses that have been incurred but not yet paid or recorded. Basically, it is an expense that has been created because of your use or accumulation of something, and thus you owe it, but you still have not paid for it yet. If this still doesn't make sense, bear with me a bit as I go through the following examples. Interest, taxes, utilities, and wages are common types of accrued expenses. I'll explain interest and wages further in detail as those are the examples we will do in a bit. So, interest. Let's say you take out a loan that has semi-annual interest payments, meaning you pay twice a year. So let's say a month has gone by since you have taken out the loan. Even though you are not paying after just 1 month, that doesn't mean you haven't accumulated any interest. You have actually. However, you just won't be paying it for another 5 months. This is an accrued interest expense. You have accrued it and you owe it, but you just haven't paid it yet. Our next example is wages. So let's say a company pays its workers every 2 weeks. And now assume that it's been 1 week since the last payday, meaning that there's 1 week left until the next one. Even though it's not currently payday, the company now owes its employees 1 week of wages because they have been working a week since the last time they were paid. And thus, the company has accrued that wages expense for the 1 week of unpaid work. So, how do accrued expense adjusting entries look like? They are like this. A debit is made to the expense account and a credit to the payable account, which is a liability. Why do we credit a payable account? Well, remember, the company has accrued the expense, and because they have not paid it yet, but instead owe it, they have to record it as a payable. So now I'm going to go over the examples with you. Our first example is with accrued interest. ABC Inc. takes out a 5-year, $120,000 loan on August 1st, 2017 with an annual interest rate of 7.5% paid annually. Prepare the adjusting entry on December 31st, 2017. So, if we pay interest annually, that means we only pay once a year. Since we took out the loan on August 1st of 2017, we don't have to pay the interest payment until August 1st of 2018. However, we are asked to record the interest on December 31st of 2017. Remember, even though we are not actually paying any interest on December 31st, that doesn't mean that we have not accumulated it. We have, in fact. How many months have gone by from August 1st to December 31st? We'll just count. September 1st is 1 month that has gone by, October 1st is 2, November 1st is 3, and December 1st is 4. A lot of people might make the mistake of thinking we have only accrued 4 months of interest. However, it's actually 5. This is because we are making the adjusting entry on the 31st. Even though this entry isn't being made on January 1st, a month has pretty much gone by, which is why we count it as an additional month. So, before we can move on, we need to first calculate our monthly interest amount. To do that, we take the $120,000 principal amount and multiply it by our annual interest rate of 7.5%. This is going to give us $9,000 per year. Then, what I'm going to do is take that $9,000 and divide it by 12 months to give us a monthly amount of $750. This $750 is how much we accrue in interest each month. Now, all we have to do is multiply that $750 by 5 months, because that's how much time has gone by, and that will give us a total of $3,750 in interest for 5 months. Now, let's write the journal entries. Remember, accrued expenses entries will always be a debit to an expense account and a credit to a payable liability. Thus, we're going to debit interest expense, and we are going to credit interest payable, because remember, we owe that money and just have not paid it yet. How much? It is by the 3,750 that we found out that we accumulated for interest after 5 months. And that is your answer. It wasn't that hard, right? Our next example is a wages problem. XYZ Inc. has 5 employees in which are paid on the first of every month. They work 8 hours a day, 5 days a week, with an hourly rate of $25. Prepare the adjusting entry on December 31st, 2017. Well, we only need to calculate the payment for 1 month because as you can see, they are paid on the first of every month. So that means the last time they were paid was on December 1st of 2017. And because right now we are making the entry for the 31st, we still haven't paid them for the whole month of work they did in December because we will be paying that tomorrow on January 1st of the next year. So where do we start? What I'm going to do is I'm going to take the 8 hours a day that an employee works. I'm going to first find the total amount of hours that is worked per employee. And then once I find the total amount of hours, I'll multiply it by 5, which is the amount of employees this firm has. And that will give me the total hours that we will be paying for. So we know that workers work 8 hours a day. They also work 5 days a week. So I'm going to signify that here. So the days will cancel out. Next, we also know there are 4 weeks in 1 month. So I'm going to write that up here. 4 weeks, 1 month. And when you multiply this across, you get you get 160 hours per month. And remember, this is just for one employee. So now what I'm going to do is I'm going to multiply that by 5 employees, and that is going to give me 800. So what is this 800? It's how many hours. If you'll remember, I calculated the 160, which is the total hours in a month that one employee works. Then I multiplied it by 5 employees, which means that all the 5 employees worked a total of 800 hours. And now all I have to do is take that 800 hours and multiply it by the hourly rate of $25. And that gives me $20,000 in wages that must be paid. So, how are we going to write the journal entries? Simple. We debit the expense account. In this scenario, it is going to be a wages expense, or you can call it salaries, whatever you like, it doesn't matter, but as long as you keep it consistent within the problem. And I'm going to credit wages payable, because remember, today is the 31st, and we technically don't pay them until tomorrow. However, that doesn't mean we don't owe them anything. We do owe them because they've worked a month and we haven't paid them yet. So we're just going to add the numbers in, 20,000, 20,000. That is our answer. Thank you guys so much for watching, and I hope that the concept of accrued expenses now makes sense to you all. And I do apologize, this is my first video. I know the filming, the visuals, and the audio of the video was not the best, especially compared to professional YouTubers, but I promise you, as I make more videos, I will definitely improve upon that. Thank you so much for watching, and good luck.